All right, guys, let's get started. Mastering Forex, day 2, entering trades and managing risk. Yesterday, we went over the basics of my trading strategy. So we went over price action, support resistance, candlestick analysis. Today, I'm going to bring those two things together to show you how to spot and enter trades. So this is where it gets a little bit more advanced. Now, this is day 2 of a 3-day webinar series. So day 1 was yesterday, day 2 is obviously today, and day 3 is going to be tomorrow. Without watching day 1, what we discussed today is probably not going to make a whole lot of sense because I'm going to be using a lot of terms that I went through in day 1. So please, if you're watching this as a recording, because these are going to be posted to YouTube as recordings, please go back and watch day 1 and then come and watch day 2. So watch day 1 first, because otherwise a lot of this stuff is not going to make sense to you. All right, so I just want to dive straight into it today. To be honest, I don't want to waste too much time because we got a lot to cover. So let me tell you what you're going to learn today. First of all, you're going to learn how and where to enter trades. So that's how to spot trades, where to enter trades, when to enter trades, all that kind of stuff. That's what we're going to be covering. We're going to be covering how to set smart targets and stops. Now, this is super important. Spotting trades and entering trades is easy. It's really not that hard. I mean, you saw the basics of my strategy yesterday, and it's really quite simple. Spotting and entering trades is easy. Where it gets hard is setting your targets and your stops. Because if your target's too big, it's never going to be hit. If your stop is too small, it's going to be hit too easy. That's where it becomes a bit difficult. So we're going to be looking at how to set smart targets and stops. Next, we're going to be looking at how much you should risk per trade. So that's just risk management. Risk management is, to be honest, the most important part of trading. If you don't know how to manage your risk, you're going to lose your Forex account. One bad losing streak is all it takes, and you're going to be gone. 50% of your account's going to be gone or more. Managing risk is very, very important, and I'm going to show you how to manage risk. Now, actually, I shouldn't really say that because I can't show you how to completely and fully manage risk. That's just not realistic in this time frame, because we only have around about an hour here. And risk management, for example, in the Forex Mastermind course, there's hours and hours dedicated to teaching risk management because it's a subject that takes hours to teach. And there's also quizzes in the course, and you're tested in all this knowledge because it's something that takes a long time to teach. So risk management is something we're going to discuss the basics of today, just kind of give you a basic outline of risk management. And if we have time, we're going to be discussing much more other things, a lot of other things, but we'll just see how it goes, how much time we have. So yeah, that's what you'll learn today. And now let's just quickly go through the rules before we jump in. So chat is going to be disabled. Well, chat is disabled right now. Reason for this is, well, the reason is I'm a people pleaser. I like to answer questions, and I like to make sure everyone who's listening is following along. So traditionally, I've always had chat enabled in my webinars, but I've learned with time that it just throws me off because I get distracted by answering questions, and it just makes the whole webinar longer than it needs to be, and I don't get through as much content as I want to. So I've decided to disable chat and leave questions until the end. So chat's going to be disabled. Please keep questions until the end. You'll notice there's a Q&A feature. Please don't spam questions in the Q&A section. Just wait till the end and I'll tell you when to add questions. And if you do add questions there, I'm just going to ignore them. It's a lot easier to ignore questions in the Q&A than it would be in an actual live chat. Recordings will be posted to YouTube, so keep that in mind. Recordings are going to be posted to YouTube. Subscribe to my YouTube channel so you get notified when I put the recording up. And keep questions on topic. This is a 3-day event, so day 1 we discussed the basics of price action, basics of my price action strategy. Today we're going to be discussing, like I said, we're going to be discussing how to enter trades and all that kind of stuff. And tomorrow, I just realized, damn it, I messed up the slides. It says price action strategy up here. It should say risk management and stuff like that. I am so bad at doing slides, guys. I'm sorry. But like I was saying yesterday, I'm not really one of these internet marketers who's really good with presentation and making things flashy. So I tend to just throw these slides together, and they end up having mistakes. So this should say, but whatever, it doesn't matter. Keep questions on topic, guys. Let's just move on and let's start talking about spotting trades. So today, to get started, I want to focus on spotting trades. Spotting trades is well, it's vital, because if you can't spot them, you can't enter them, and if you can't enter trades, you can't trade. So, how do we spot trades? What we looked at yesterday: support and resistance plus indecision equals reversal trades. That's how you spot trades. You use support, resistance plus indecision, and that's going to give you a reversal trade. It's very simple, deceptively simple. So, in this little chart down here, we see a few examples of support and resistance plus indecision gives you trades. Wait, I just want to see what's on the next slide, because I kind of forgot what I put on the next slide. Yeah, okay, never mind. We need to go back. All right, so support and resistance plus indecision equals reversal. So here we're seeing a few examples of that. Look at this trade here. So price came down to here. This is a support area down here. This blue area is a support area. It stalled on the support area, and what did we get? We got indecision, and then price moved away from the support area. Then we got that happening again. Price pushed up to here. We got indecision on a resistance area. So this is a resistance area. Then price moved away. Then this was a tradable setup, but it's not tradable in the sense of what we discussed yesterday. This is something a bit more advanced, so we'll just skip that for now. See, price fell back down into here, indecision there. See that indecision candle, and it pushed away. So this is really, really common in trading, having these kinds of setups. So there's 3 steps to spotting a reversal trade. A reversal trade, it comes in 3 different steps. The first step of a reversal trade is the preceding trend. So this is the preceding trend. Actually, let's say this whole thing is the reversal, right? You know what? I think I've got a better way to do this. Frame, 1 sec. All right. This is the reversal. This entire thing is the reversal. So now I'm going to break down the 3 parts to a reversal. So here are the 3 parts. Part number 1 is the preceding trend. That is the preceding trend of the reversal. So preceding trend just means it's just a minor trend that heads into an area of support or resistance. So this minor trend headed from here to here. It headed into the area of support resistance. So if you remember what we talked about yesterday, when you're reading the candle story, remember the candle story? And remember the very, very important question that you need to ask yourself whenever you look at a chart? You should remember it, because because I asked you to write it down, and it's vital. It's the most important question in Forex. Who is in control of price? So let's ask ourselves that question while we look at this trend. Each candle, we're going to ask ourselves that question, okay? So who is in control of price? Candle number 1. The bears, because price is pushing down. Sellers are in control. Bears are in control. Candle number 2, bears. Candle number 3, it's not pushing down as far, but obviously it opened here, closed there. Overall, we would say bears or sellers are in control. Candle number 3, sellers are in control. Candle number 4, sellers are in control. Candle number 5, that candle gets really small. So that candle is getting really small. And why is it getting small? Because it's on a support area. What is a support area? A support area is a group of buyers. Support is a group of buyers. When price hits support, buyers start buying and the sellers get weaker. And that's exactly what happened here. So we got sellers in control, sellers, and then sellers start losing control. Then what happens? Then we get this candle here. Now this candle is a clear indecision candle. Now let me break down this indecision candle for you. This candle moved down, so it created a low as if sellers were going to keep pushing down, but they weren't able to hold that low. They weren't able to push down any further. They pushed down to here, but then they got turned around. Buyers regained control. So the buyers in this support area were able to turn price around and take control. They were able to push the sellers up. So from down here, they were able to push the sellers back up to here. Not only that, they were able to create a new high. They were able to push price up to there. So we went from a trend completely controlled by sellers, to buyers fighting back and almost winning against sellers. I mean, I wouldn't say buyers are in complete control after this candle, but buyers are fighting back against sellers. This is indecision. Neither buyers nor sellers are in control. So that is part 2. So this is part 1. Preceding trend. Part 2 is indecision on support or resistance. This one is on support. So indecision is forming on support. Step 3, sure you can guess what this one is. Here, I don't like red in this example. Let's use blue. I prefer blue. No, that's way too dark. Damn it. Cyan? That's a blue, light blue. There we go. Now you can see it. So this is the reversal trend, right? So this is the reversal trend. This is where you make your profit. This is where you've entered the trade and it's pushed up to here and you've made some profit. So what's happened here is we went from sellers, it's getting a bit confusing with all these drawings. Let me clear them. Back to the arrow. So we went from a trend controlled by sellers, so bears being in control. They hit support. What is support? Support is a buy area. Support is where buyers take control of price, or where they attempt to take control of price. And in this case, they did take control of price. So we went from a seller-controlled trend to indecision on top of support to a reversal trend. That was a reversal trade. That is the 3 steps to a reversal trade. Now, this can happen either as a long trade or a short trade. So see this reversal trend? This reversal trend acted as a preceding trend for the next reversal. I know that's a bit confusing. So let's just forget that for a second and let's focus on actually breaking down this setup here. Quickly. Oh, damn it. Sorry, that's the wrong tool. Righto, here we go. So, this is another reversal setup. Now, you should be able to identify the steps at this point. We got step 1, preceding trend. So that's the trend where price pushed up. That's the preceding trend. That one's this one. Step 2 is the indecision, which is here. We can see that little indecision candle, and that indecision candle formed where? Formed right on top of resistance. So this is indecision on resistance. So that indecision candle, let me tell you what happened there. Let me break it down for you. We had a trend that was mostly controlled by buyers. There are a few little red candles here that indicate sellers are fighting back, but overall this trend is controlled by buyers because it's moving up. It's pushing up. So buyers are in control for most of this period. Then it hits resistance. When it hits resistance, we get this little indecision candle. And then of course, price eventually turns around. And that is the reversal trend. This one here is the reversal trend. Let me highlight it for you guys. Reversal trend. So that's the 3 steps to a reversal. You got the preceding trend, the indecision, and the reversal trend. Now, actually, let me go back to that real quick. One important thing to note about the indecision. This is something a lot of people forget for some reason. Indecision, where? Where is this indecision? It is on support or resistance. On support or resistance. I'm not sure how I can make this any clearer. And the reason I'm stressing this is because so many people start trading my strategy, and what they'll do is they'll see this candle here, this little candle here, and they'll say, okay, I'm going to take a short trade here. But that indecision candle there is not on support or resistance, nor is this one. This one's below it. It's below it by a fair way. You want your indecision to be on top of support or resistance. Indecision on support or resistance. On. There's a big difference between it being on there and it being not on there. Because what is happening here... Actually, let me explain this in another way. What is indecision? Just what does that word mean? If you look it up in the dictionary, indecision means the inability to make up one's mind. Something like that anyway. The inability to make up one's mind. So if a person is indecisive, they can't make up their mind. So that is what an indecision candle is. It's a candle that can't make up its mind. When price cannot make up its mind, when neither buyers nor sellers can gain full control of price, price is undecided. But just because you see indecision, it doesn't mean that you're going to have a reversal. Indecision does not equal reversal. This candle does not equal reversal. This candle does not equal reversal. This one does not equal reversal. Just because you see indecision, it doesn't equal reversal. Here's a good example. See this one here? Price pushed up, we got indecision. It started to reverse, but it didn't fully reverse. Indecision does not equal reversal. Indecision just means that price is undecided. What you need is indecision forming on support or resistance, because then you've got the backup of buyers and sellers. So a support area, what is a support area? Support area is an area full of buyers. This is a support area. Resistance area is an area full of sellers. When indecision forms on support or resistance, it's much more significant, because then you have the sellers from resistance backing you up and you have the buyers from support backing you up. And there's also another important point, but that comes down to entry, so we'll talk about that in a second. So these are the 3 steps to a reversal trade. Now we're going to switch over to a live chart soon, and I'm going to show you this on an actual live chart, and it'll be a lot clearer then. Actually, let's switch to a live chart now. I thought there was another slide. Well, whatever. We're going to switch to a live chart now, and I'm going to show you a little bit about, I'm going to show you how to spot these trades on a live chart. And I'm actually probably going to show you some real trade examples. I have a few lined up. So I'm going to be showing you examples of trades that I have actually taken recently. So these aren't just theoretical trades. These are trades I've taken. And you can verify I've taken those trades because you can look at YouTube. You can look at my analysis. I share trades in my analysis. So I say, hey guys, this is a trade setup. I'm probably going to enter this one today, blah, blah, blah. So these are trades I've shared in my analysis. And you can see, yeah, my point is you can verify the trades. Anyway, let's switch over to a live chart and we'll take a look at those trades. So just give me a second here. All right, some of these trades have been marked, well, no, all these trades have been marked out. Like I said, these are setups which I've actually traded. They're real trade setups. These aren't just me looking back on my chart and, you know, finding something that looks good. Most of the ones we're going to talk about are real trade setups. I'm probably also going to talk about some trade setups that I skipped or I didn't take, or some trade setups that my students took. We'll just see how much time we have and how many setups we can get through. But I just want to show you how to spot proper trade setups, right? And you can verify that these are real trades by looking back on my YouTube channel, because I called these trades before I entered them. I'll probably link you guys to the videos or something, but just subscribe to my YouTube channel for analysis. I do analysis 3 days a week. Anyway, I wanted to quickly show you. This is one of the better trades I've taken in the past. I think it was taken on the, no, it was taken on the daily. One of the better trades I've taken in the past few weeks. In the past few months, actually. This one was a nice little trade. And a lot of people followed me on this trade. And a lot of people ended up making more profit than I did. But anyway, let's break down this trade. I want to break it down step by step for you. Because the examples I just showed you, right, they were perfect examples. You know, they were picture perfect examples that I picked because they're easy to illustrate the concept of reversal trading. But in reality, it's never really that, well, no. Sometimes setups are that pretty, but a lot of the times they're not that pretty. They're not that good looking. It's not that simple to see them. So I'm going to show you this setup and why I considered it a trade. So remember, the three paths to a reversal trade: the preceding trend, the indecision on support or resistance, and then the reversal trend. The reversal trend is where you make your profit. So let's look at the first part. First part, preceding trend, was this. So this was the preceding trend. Now, when you look at this trend, right, buyers didn't have control the whole time, but we still know it's a bullish trend and we still consider it a bullish preceding trend because overall buyers had control. Now, how do we know that overall buyers had control? Because it moved up. This was a bullish trend. Buyers overall over these 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Over these 10/11 days, buyers had more control of price than sellers because buyers push price up. So the bulls push price up. The bulls push price up until it hit resistance. When it hit resistance, what happened? So let me highlight these so we can separate them. So this was the bullish preceding trend. When price hit resistance, what happened? We got this little candle here. Now this was the first sign of indecision. This was the first sign that buyers were slowing down at this resistance area. Because what is resistance? Resistance is an area full of sellers. So resistance is what resists price. It resists price from moving up. It's a ceiling, remember? So price hit that ceiling. It smashed into that ceiling and it stalled. It stalled right on that ceiling. It couldn't really move up any further like it had been doing for the past few days. Now, this first candle to me was really not enough for me to enter the trade. It just wasn't a strong enough sign of indecision. But then we got a second day of indecision. So for 2 whole days, price got stuck on this resistance area. So for me, that was enough of a sign to enter a trade. Now, you might be thinking, well, what about these? This was indecision. Why didn't you enter a trade there? What about that? That was indecision. Why didn't you enter a trade there? Because this indecision up here formed on resistance. This other indecision didn't form on resistance. This one formed above support, or this one formed higher than support. So this is an important concept that I don't think I've discussed, so I'm quickly going to explain it now. These areas do not change. When price breaks through them, they do not get removed. They stay on your chart. They are adjusted with time, but they stay on your chart. When price is below an area, that area is resistance. So price is here now. The level of price is here. This is resistance. This is resistance. This is support instead, because when it's below, it's support. So that analogy I used yesterday, the floor and the ceiling. The floor and the ceiling. So this is the ceiling is resistance, the ceiling is always above price, this is the floor is always below price, this is support. Support is above like a ceiling, resistance is above like a ceiling, support is below like a floor. So, the reason I'm going through this is because here, when we got indecision, this had just broken above what was formerly the ceiling. What was resistance? This was resistance. Price broke above resistance, tried to come back down, but this at that point had become support. So we don't want to take a trade there, because if we take a trade there, what are we doing? We're selling into support. We're selling into an area in which there are buyers. We're selling into the floor. We're expecting price to smash through the floor in order for us to hit our target. We don't want to do that. That's not how we trade. This here was a safe trade. This one here was a safe trade because here we had buyers pushing up. We had the preceding trend, that's step one. We had indecision forming on resistance. So resistance, the ceiling, indecision was forming on the ceiling. And then we got the reversal trend. So then price turned around and started pushing down. So the question is, where is the entry point? Where do we get into the trade? Now, this is where the concept of highs and lows comes in. I wanted to cover this concept yesterday, and I kind of want to cover it today, but to be honest, we don't really have enough time to get into it in full. So we're just going to kind of briefly gloss over it. My entry trigger, I enter trades based on breaks of highs and lows. So I take the indecision candle, I look at the low of the indecision candle, oops. This is the indecision candle that I'm basing this trade on. I place my entry trigger just below the low of the indecision candle. So it would be around about here, just a few pips below the low of the indecision candle. Why do I do that? Why? Why is that significant? Because it's in a seller's nature, it's in a bear's nature. You know, bears are sellers, bears push price down. It's in a bear's nature to create lower lows. It's in a bear's nature to push price lower. So when sellers push price lower than the previous candle, that is a sign to me that sellers are in control of price. So when sellers push price lower, that is a sign to me that they've taken control of price. So this reversal setup, there's three things happening. We have at the start, we have the bullish preceding trend, but there's three things happening. After we see the bullish preceding trend, price hits resistance. What is resistance? Resistance is an area full of sellers. Resistance is a ceiling. Resistance stops price from moving further up. Price hits resistance. Indecision forms on resistance. So indecision, what's that? That's telling us that price went from being decidedly bullish, from buyers being in control, from price pushing up, it went to being undecided when it hit resistance. So that's number two. So number one, we have the resistance, price hitting resistance. Number two, we have indecision on resistance. Number three, we have sellers creating a new low. Sellers pushing price down. Sellers taking control of price. So those three things is what gets me into a trade. Price hits resistance, indecision forms, sellers take control and start pushing lower. That's what gets me into a short trade. That is a short reversal trade. And this trade worked out really, really well. As you can see, ended up being a really good trade. Now, obviously, this doesn't always work out. You're not going to be successful every single time. I mean, if you would, then the Forex market wouldn't exist, because if someone was successful all the time, the Forex market couldn't exist because everyone would be buying and selling at the same time. Anyway, point is, it doesn't work every time. So here's another example of it not work, but I don't think that was actually traded because there was other reasons not to trade that one. That one was filtered out. So let's look at this example. This is a better example of it not working out because I think this one was actually something that I traded, or I was considering entering as a trade, if I recall. I could be wrong. It's hard to remember trades from several weeks ago, but I think I might have possibly planned to enter this one. So this is an example of it not working out, because it's not always going to work out. So this is an example of it not working out. So here we have a bullish preceding trend, buyers in control of price. We have indecision forming on resistance. Price starts to turn around, it creates a new low, so this trade was entered. You don't have to wait for the candle to close, the trade's entered when the new low is created. And the trade didn't really work out, it didn't really do anything. I don't think I actually entered this one though. I think I was planning on entering, but whatever. The point is, it's not always going to work out for you. It won't always work out. Sometimes it will, sometimes it won't. But it's going to work out most of the times if you know what you're doing. If you can filter out bad trades, it's going to work out most of the times. Now, as far as preceding trends go, you don't really need the preceding trend to be huge. It doesn't need to be a huge trend. It can be a single candle. So let's look at this example here. This doesn't actually look like a trade until you go down to a smaller time frame. But when you get to the smaller time frame, it looks more clearly like a trade. So several of my students entered this trade and it ended up being a successful trade. Yeah, let's. I wanted to go through only my trades, but I think we'll go through this trade because it's a really good example of a nice small preceding trend, but a tradable setup. So we have a very similar thing here. This is just on a smaller time frame. So we have a nice little preceding trend, very short preceding trend. We have indecision forming on resistance, and then we have the reversal trend. Now this one spiked up higher, but the stop loss wasn't hit. So that's fine. It ended up pushing lower and hitting target. So you don't need these big, huge preceding trends. You can even get in with these small preceding trends on lower time frames. Small little trend, but more than enough room to make a decent profit. And this one was a really good trade because it was in line with the major trend. So if you just look at the daily chart, you can see that the major trend here was bullish, so this trade was counter trend, or this failed trade here. Even this one was counter to the bullish trend, but this one is with that bearish trend. Anyway, I think I'm getting into a topic that's a bit too advanced right now. This is something that takes quite some time to cover. Counter trend and stuff like that. So let's just move on for now. Let's move on and let's look at some other examples. EuroCAD. Now this trade was taken, I think, around the 22nd. Yeah, it was taken the 22nd of June. Now this one was actually taken as a live trade video. If you refer to my YouTube channel, you'll see that I actually traded this live in a webinar. So this all happened, this trade actually unfolded live, which was pretty cool. This was on the 6-hour chart, I believe. Was it the 8-hour? I can't remember what specific time frame it was, but it was either the 6-hour or 8-hour. I'll link you guys to the YouTube video. That way you can see how this trade unfolded live, and you could see me discussing the entry and the exit and all that kind of cool stuff. All right. Anyway, so this setup here, EuroCAD 8-hour chart, 22nd of June this year. Now this is another example of a trade that has a small preceding trend. So it's not a huge preceding trend, but it was a nice little trade. Why was it a nice little trade? It was in line with the major trend. So that indicated that that we could probably easily hit our target, gave us a nice target. And it was just a nice little setup. So let's break down this setup. I'll break it down real quick and I'll explain the core parts of this setup. So we have the bullish preceding trend. We have indecision on resistance, and we have the reversal trend. So this had all three parts of a reversal: preceding trend, indecision on resistance, reversal trend. Awesome. So I don't really know what else to say about this setup. It was just a nice little setup. You can see it traded live, so I'm not going to go into too much detail because you could just watch it, how I traded it. The entry was, if I recall, around about here. So when after price broke the low of this indecision candle, that trade was entered. It pushed all the way down to here, gave us a nice risk to reward ratio. So let me actually, I forgot to use this tool. So the trade played out something like this. See, this red area is from my entry to my stop loss. This green area is my target. I can't remember how much I got on this trade, but it ended up working out well and it hit target. Now there was another EuroCAD example I wanted to show you that's very similar. It's a bit more recent. I think it was this one here. Yeah, this one was on the 12-hour. Very similar setup, but a bit more recent. Now, I didn't enter this one, but I just wanted to show you this one because it's a very similar thing. What you want to look for generally is indecision forming on top of the arrow, because the closer to the middle that indecision forms, the better, generally speaking, that the setup is going to be. So you want to look for indecision forming kind of on top of your support resistance areas. I think there was an AUD-JPY example that I wanted to share real quick. This was another trade that I'm pretty sure I shared this trade in my analysis video around about that time, around about the 4th or the 3rd. Yeah, the 4th of this month. So yeah, this is just another trade example, and it's using the same concept. We're looking for preceding trend, bam, we got the preceding trend. We could even say it just started here. Buyers had control of price. We've got indecision, and we got the reversal trend. I don't really know if we should go over any more examples because they're all pretty obvious. I think we should talk about targets and stops and all that kind of stuff because that's a bit more important right now. And also keep in mind that not all these trades are going to be successful. I've already said that, but I just want to make that clear because I'm showing you examples of successful trades, but I'm just trying to find an example of a failed trade. Can't really see one right now. Look, it doesn't matter. The point is, not all these trades are going to be successful. This strategy does have a high hit rate, over 60%. Now, to a lot of new traders, 60% doesn't really sound too good. Over 60% sounds bad, but 60% for Forex is for any market is amazing because you got to remember you make more on your wins than you lose on your losses. So that 60% actually ends up being a whole lot better than it sounds when you're actually trading. So yeah, let's switch back to slides because I want to talk about stop losses and targets. Very important subject, and I want to discuss that because we don't really have that much time left. So I want to talk about stop losses and targets. All right, so why are you looking at a picture of a mountain and a valley? Because I find that this is the easiest way to explain stop losses and targets. It's an analogy for stop losses and targets. All right, so let's say, God, here I go, trying to draw a picture of a person. A very big person, apparently. Let's make that smaller. Let's say that's you. Your car's broken down out in the wild and you have to make your way home. You're stuck, you're stranded, you can't drive, you have to walk. Now, you don't know where the closest town is. You've got no idea where the closest town is. It could be in either direction. Where's the most logical way to walk? Where are you going to walk? Are you going to walk here and go over this snow-capped mountain, possibly freeze to death at the top of the mountain, come back down and try to get to the closest town? Or are you going to walk this way over the big, nice, open valley? Easy ground to cover, not many ups and downs. You can just kind of easily walk for miles and miles and miles. So what's the logical choice here? Going up the mountain over this big barrier here, this huge barrier, possibly freezing to death, or going this way, the easy walk? I think I think the answer to this question is quite obvious. It's quite easy. You're not going to walk over the mountain because that would be crazy. That's dangerous. It's a lot easier to walk that way. Now, price reacts in a similar way to a person. Price generally takes the path of least resistance. So when price moves, it takes the path of least resistance. When it hits barriers, it stalls. So this barrier here, this is an area of support or resistance. This here is a big open plane. So let's switch back to a chart because I want to illustrate this example. We're going to go back to actually the USD/JPY because it's a nice clean example to go over. You see this USD/JPY, even this USD/JPY trade, the exact same trade happened twice. So see, this was the first time back in May of this year. Price pushed up. So see, we have the preceding trend here. Price pushed up. Price hit resistance, indecision formed, and it turned around. So that was a nice little reversal trade. And then, this was the trade I took. Like what? 2 months later, we got the exact same thing happening. Price pushed up to this area. We got indecision and it reversed. So it was the same thing as previously. So let's look at this example and let's look at where stops should be and where targets should be. All right? A very, very simple concept, placing your stops and placing your targets. I think we'll use this tool. So you already know where your entry should be. Your entry should be when price makes a new low. So it should be just below the low of the previous candle. So this is the new low, just below the low of the previous candle. And if you were going for a bullish trade, if you were buying, let me show you an example of a bullish trade real quick. This isn't something I actually traded. That's a bit of a messy one. It's hard to remember the trades you've taken several weeks later. But let's just pretend I took this one just to illustrate this example, this one here. Right, so we have the preceding trend, we have indecision on top of support. This one got a bit messy, but it's still in theory a tradable setup. So in this case, if you're going long, the entry point would be just above the high of the indecision candle. So it would be around about here. That would be the entry point, right? Cool. So let's go back to here. And I want to show you how this trade was taken, how this trade was traded. I can't remember the precise numbers, but this is roughly how you would take a trade like this. So your entry would be at the low of the indecision candle, as we've discussed, just below the low, just a few pips, 3 or 4 pips below the low. So that would be the entry. Where does your stop loss go? Your stop loss needs to go behind barriers. So going back to this mountain analogy real quick, if this is price, how would you illustrate price? Let's just say this cross here is price. We're entering a reversal trade. We want our stop loss to be over this mountain. We want our stop loss to be here. We want our stop loss to be behind a barrier, behind this barrier, because when it's behind a barrier, it becomes harder for price to hit that stop loss. Because it's behind a barrier, it's hard for price to hit that stop loss. So when it tries to hit it, comes up against the barrier, and it can't hit it. I mean, theoretically it could, but it's harder for price to hit that barrier. So we want our stop loss to be beyond a barrier. We want our target to be out in the open. We want our target to be here. Because what does that mean? That means our stop loss is hard to hit. Our target is easy to hit. Make sense? Hopefully it does. So going back to this chart, our entry is here, our stop loss is here. Why is our stop loss here? Our stop loss is here because it's behind two barriers. Number one, the most important barrier, is the resistance area. So we got an area of resistance. Now, this resistance area, what you want to do when you're placing your stop loss, you want to place it above, and remember the shaded part is not that important. You just want to place it towards the top side of this middle line that you've placed. You want to place it as high above the resistance area as you can while maintaining a good risk to reward ratio. So what do I mean by risk to reward ratio? That's the number here. If your stop loss is up here, your risk to reward ratio becomes 0.5. That means your stop in relation to the size of your target is 0.5. So you're risking, let's say, 200 pips, and you're only getting 100 pips in return. That's not good. So you want to have your stop loss as high above resistance as it can be while maintaining a good risk to reward ratio. So we're going to place it here in this example. I think that's roughly where I placed it. So our stop loss is behind the barrier. It's behind resistance. So this is the resistance line. It's behind resistance. But it's also behind the high of the indecision candle. The high of the indecision candle is another barrier. The high of the indecision candle is the highest point price has been able to reach in a significant amount of time. This is the highest point price has been able to reach in at least a few days. So price hasn't been able to get beyond this high in a few days. So that's another significant barrier. It's a psychological level. It's a significant high. It's a high of, well, in this specific case, it's a high that hasn't been hit since March 2017. So this was the last time price was beyond this high. So that is a very significant barrier. So our stop loss is behind two barriers. So the barrier, the mountain, it's behind a mountain. Our stop loss is behind a mountain. Our target is out in the open. Our target, let's say, is here. Risk reward ratio of 1.5. That means your target is 1.5 times the size of your stop loss. So if your stop loss is 100 pips, your target's 150 pips. That's the minimum I go for. Minimum risk to reward ratio is 1.5. So in this case, we have a risk to reward ratio of 1.5. We have, and we have met all the requirements for a good stop, for a smart stop and a smart target. Smart stop, behind a barrier. Smart target, out in the open. Smart stop behind barrier, smart target out in the open. It's very, very simple. That's all it comes down to. Having a smart target and a smart stop just means your target is out in the open. Your stop loss is behind the barrier. So that's how you place a target and a stop. Let's quickly look at another example. I think I might show you the AUDJPY example actually. We don't have much time, so I'm just going to show you one more example, but it's a very simple concept, so hopefully you guys get it. The thing about webinars is you only have about an hour, so I try to squeeze everything I can into this hour. It's not like a course where you have like hours and hours to explain everything in a lot of detail. So yeah, in this case, our entry is roughly here, just a few pips below the indecision candle there. Stop loss is here, it's above. So it doesn't have to be above the top of the shaded area because the shaded area doesn't mean anything. It needs to be above that center line, this line here. The shaded area, like I've said multiple times, the shaded area is just there because I think it visually looks better. It's easier for me to analyze when I have this shaded area in there. But it doesn't mean anything. It just needs to be above the center line. So, and when I say above, I mean as high above the center line as you can get it without disrupting your risk to reward ratio too much. So the stop loss is roughly here. Target is out in the open. So when I say out in the open, you don't want your target here. You don't want your target behind this support area, because what is support? Support is a barrier. Support is like a mountain. You don't want sellers to hit your target. You don't want sellers to have to go through here and break through support to hit your target, because support's going to act as a floor and it's going to stop price from moving down. And in this case, it did that. It got to around this support area and it just couldn't push through. And then it pushed back up. So if your target was down here, you would have failed. But if your target's up here, you can get a pretty awesome target. You can get a risk to reward ratio of 1 to 2. You could get a risk to reward ratio of 2.5 even. Although that would have been a tad risky. But you could have got a good risk to reward ratio on this trade while maintaining a nice safe stop, smart stop, and keeping your target out in the open. So your target needs to be out in the open. You don't want your target to be behind barriers. You don't want your stop to be, oh God, I'm mixing it up. You want your stop to be behind barriers. You want your target to be out in the open. That's simple. Very, very simple. All right. I quickly need to discuss risk management. So let's switch back over to the slides, and we'll go over risk management just really briefly, because we're running out of time and we still need to do a Q&A session. All right, I wanted to discuss risk management in a bit more detail today, guys, but I'm just thinking about it now. We don't have the time. We just really don't. We need to do Q&A still. We don't have the time. I might try to slot some of the risk management talk in to tomorrow's webinar, but tomorrow we're going to be focusing on one of the most important parts of trading. Well, honestly, risk management is also one of the most important parts, but tomorrow I want to talk about psychology, trading mindset. Trading mindset is very important, and I have also a really big announcement tomorrow. So please ensure that you attend tomorrow's webinar. I'll try to slot some risk management talk into there. You know, smart targets and stops, they are a form of risk management. Let me quickly bring this over. Smart targets and smart stops, they're a form of risk management. A smart target and a smart stop is risk management, because what you're doing is you're setting a smart target and a smart... All right, I'm just repeating myself way too much. What you're doing is you're setting a stop loss that's hard to hit and a target that's easy to hit. So that is risk management. You're managing your risk by making your stop hard to hit and by making your target easy to hit. So let's just summarize smart targets and smart stops, and then we'll go over to Q&A. So smart targets are in front of support resistance areas. What do I mean by that? What does in front of support resistance areas mean? Because I didn't really explain this too well. Let's go quickly show you USD/JPY. The USD/JPY example I was just showing you. We'll just stick to that because it's the easiest one for now, and I'll get another example for a long trade. I think there was one on AUD/USD recently. So let's, when I say your target is in front of, in front of SR areas, in front of support resistance areas, that means your target is before an area of support resistance. So for a long trade, was AUD/USD? Yeah, there we are. For a long trade, that means, I think this was, yeah. Long reversal trade, that means you're, I need to zoom in a lot here. Right, here we are. So, for a bullish reversal trade, that means your target is before the next resistance area. So let's just move the resistance area down to here just to make this example easier. So you're entering a long trade. There's a preceding trend, there's indecision. We want to enter a long trade. We enter it here. We make sure that our target is in front of the resistance area. This is resistance. So in a short trade, your target needs to be in front of support. On a long trade, your target needs to be in front of resistance. So that's a smart target, as long as it's not too small. That's another important factor. That just means if, let's say in theory, the area was down here, We don't want our target to be too small. If our target's too small, we have a bad risk to reward ratio, so there's no point getting into the trade. Now, smart stops, just summarizing those. You want your stop loss to be, I forgot to say, the less barriers a target has, the better. That's just common sense. The less barriers, the better. Smart stops are behind SR areas. The more barriers a stop has, the better. So, smart stop is behind this resistance area here, and it's behind the low of that indecision candle. So it's behind resistance and a low. That's a smart stop. Smart stop is behind, and in the example of a short trade, your smart stop is behind daily, is behind this resistance area, and then it's also behind the high of that indecision candle. So it's behind two barriers. The more barriers, the better. It's behind two barriers. Awesome. So that's a smart stop. And as long as it's not too wide. So as long as your stop's not too wide. Now the reason for that is if your stop becomes this wide, because that is technically a safer stop. If your stop is up here, it's behind a lot of barriers, isn't it? It's behind this resistance area. It's behind that resistance area. It's behind that high. Behind that high. Behind the highest point it's been in a long time. But if your stop is that wide, then your risk to reward ratio is going to be pretty crappy. You're going to have a 0.19 risk reward ratio. So let's say you fail one trade. You're going to need a lot of winners to catch up if you're trading with that kind of risk reward ratio. So you don't want your stop loss to be too wide. You want to have a smart stop, but you also want to keep your stop loss, you also want to keep a reasonable stop loss. Reasonably sized stop loss. That way your target doesn't need to be too big. So that's how stop losses and targets work, guys. It's pretty straightforward, pretty simple when you think about it. But a lot of people in trading, a lot of traders, they like to use these 20 pip stop losses. So they say, oh, I'm going to have a 20 pip stop loss on every single trade I take, or a 30 pip stop loss. But that just isn't smart. That's not how trading works. If you have a 20, a 30, a 40 pip stop loss on every single trade you take, or if you just place your stop loss anywhere, your stop loss isn't safe. That's bad risk management. That's bad risk. You're taking way too big a risk. Your stop loss needs to be behind barriers. When your stop loss is behind a barrier, it is a lot safer and a lot harder for price to hit. And if putting your stop loss behind a barrier makes that stop loss too wide, so let's say, for example, our stop loss, let's say resistance was up here. And, oh no, this is a crappy example. But point is, if your stop loss is too wide, you just shouldn't take the trade. If to get your stop loss in a safe place, you have to make it too wide and it gives you a bad risk reward ratio, you shouldn't take the trade. I wanted to discuss risk reward ratios today in more detail, but it seems like we can't. We just don't have the time. Just keep in mind that a good risk to reward ratio is 1.5. That is a minimum. So that's a good risk to reward ratio. The minimum is 1.5. Now, that's, like I said, that's the minimum. So generally speaking, for a risk to reward ratio, I aim for 2 or more, but my minimum is 1.5. And what does that mean exactly? Just for those of you who don't understand a risk to reward ratio, that just means your your target is 1.5 times the size of your stop loss. Risk reward ratio of 1.5 means your target is 1.5 times the size of your stop loss. So if your stop loss is 100 pips, 1.5 times 100 is 150. A risk to reward ratio of 2, that means your target is double your stop loss. If your stop loss is 100, your target is 200. All right. What I'm thinking is 1953. We've been gone for about an hour. I think I've covered pretty much everything I wanted to cover today. I wanted to jump into risk percentages, what percentage of your account you should risk, and losing streaks. But we're running out of time. We're not going to be able to do a Q&A if I keep going. because that other content's going to take a little while. So I think we'll just do that tomorrow. That's the beauty of doing a 3-day webinar. We can push stuff until the last day. So yeah, we'll just do that tomorrow. All right, guys. Yeah, feel free to ask questions now if you have any questions about what we've gone through today. Rob Fitzgerald, hi Nick. Of all the skills I need to learn to be consistently successful trader, for me, learning to take profits is probably the most difficult to master. Quite a lot of times I miss target by a few pips and I'm not around to close the trade. That just probably means that you're not setting smart targets, Rob. The targets we just discussed, smart targets, they're the ones that are going to be hit. If your targets are being missed, it's probably because they're behind barriers. That would be my guess anyway. 60 Galoo, is indecision always marked by a small candle? Almost always, yeah. Indecision is almost always a small candle. Steven Jackson, may we see the slide again? Certainly you can. If I can figure out where I put it. Here we go. Jim, how do you avoid head fakes on reversal trades? You mean how do you avoid? I'm not sure what a head fake is. Do you just mean bad trades? How do you avoid bad trades? On the last short USD/JPY trade last week, I got stopped out. The following big red candle hit my stop loss and then turned around. How do you handle those trades? Oh, we'll look back at that in a second. I just want to keep the slide up for Steven who asked to keep the slide up. Yeah, so Jim asked, how do you avoid head fakes? Jim, it sounds like you're just describing a failed trade. You can't avoid failed trades. Failed trades happen. You can obviously, with experience or use certain criteria to decide that the setup itself is not a great setup. Usually, if you're doing a trade that's completely counter to a major trend, generally speaking, you're going to want to target a little bit less. So you're going to want to stick to that minimum 1.5 and not go beyond that, because if it's against a major trend, it's unlikely that it's going to reverse that far. But yeah, other than that, you're just talking about failed trades. Sometimes reversals don't turn into reversals, and those end up being failed trades. Jim, do you take momentum when assessing taking a reversal trade at a support resistance level? Well, yeah, like I just said, I do factor in the trend. If I'm trading against a strong trend, I'll definitely factor that in. What criteria do you use to extend a trade, Adrian? That is a very complex subject, and it is something that I can't get into because it would just take ages to go through it. Steven Jackson was asking earlier, do you have a rule for losing streaks? That's something we're going to discuss tomorrow. I'm going to discuss losing streaks tomorrow. What is the best time frame to trade? Generally speaking, the 12-hour chart for me at the moment. All right, guys, that's all we have time for with Q&A. Tomorrow's Q&A will be longer. In tomorrow's webinar, we're going to be discussing one of the most important aspects of trading, that is trading psychology and mindset. And we're also going to be taking a look at losing streaks, which is also really, really important. I'm going to teach you a few things about losing streaks, a few very important things. And I also have a very cool announcement for tomorrow's webinar. It's a very cool announcement. It's about a free thing that I don't want to spoil it. It's about something that I'm releasing that's free that you guys are going to love and that I think is going to be pretty cool. So yeah, come to tomorrow's webinar, check it out. It's going to be pretty good. I'll see you guys tomorrow. Thanks for attending. See you later.